front. What can we do now to put you in a better tax situation in the future? And I think we can all agree with the state of our economy, state of the government right now, taxes are probably going to increase because we have a little bit of debt out there. I did give you, or Charmaine gave you, on your table, our tax cheat sheet. Sometimes when you're sitting with us in the conference room, you'll see Alan and I refer to this because it has a lot of tax stuff on it. We update this every year. So it has standard deduction, income tax brackets, maximum contributions. So it has a lot of information on here. This is where you go to. There's one, I don't know which side you're looking at, on the back. The one that doesn't have our logo at the top. RMD rates. So the Uniform Lifetime Table, that's your required minimum distribution rate. Easy way to figure it out is if you know what your end of year balances are, you can use the divisor, go to your age. Let's say at age 75, that divisor is 4.22. So basically, take all of your IRA assets and divide it by that 4.22. That'll give you an estimated RMD. So good little cheat sheet to have. Just keep with your records. Easy to reference to because we use it all the time. So what a lot of people don't realize is it is possible in retirement to take tax-free capital gains. So depending on where your income is, if you are within this range up to, let's say you have total income of $50,000 in 1 year, and you have a stock that has $30,000 long-term capital gains, you can actually sell that stock and pay 0 capital gains on that because it's under that $89,000.
So you pay 50%, say it's 95,000. You pay the 15% between the 89, 250,
yep.
95.
Mm-hmm. And that's something I didn't go into a little bit. Some people do think if you, let's say you have $100,000 worth of taxable income, they think once you hit that 24% tax bracket, you're paying 24% on everything. You're not. You're paying 10% on the first 11,000, 12% on the 11,000 to 44,000. So it's stair step. A lot of people think, I don't want to get into that tax bracket because I'm going to pay so much more. You're only paying that extra tax on that little bit that you get in that bracket. Good point, thank you. But most of the custodians will send you the form if they have your capital gains in there at the end of the year. I think Fidelity does it by February 15th. I think that's when they send out all their documents. They should send you that form that says long-term capital gains and short-term. Another big change is contribution limits. Now, if you're retired, which you are here early on a Friday morning, so I'm assuming not everybody's working, so this might not affect you all. But 401k limits did go up this year by about $2,000, and the catch-up limit. Again, this doesn't affect you all, but with the Secure Act 2.0, that catch-up limit's actually increasing even more for ages 61 or 60 to 63. It's actually up to $10,000 that if you're within that age range, you can contribute more if you're still working. I don't know 100% why they chose that age range. It's kind of like the RMDs being at 70 and a half. Doesn't make a lot of sense. Just brings up a lot of questions. So they don't explain that stuff. But IRA limits increased too. Standard deduction increased. Pretty decent jump. It's up 27.7. So this is one of the things that the Trump tax plan changed back in, was it 19 when it went through, or 17? This does disappear. Standard deductions go back to the original amount at the end of 2025. So right now, a lot of people aren't itemizing their taxes. Taxes are pretty easy. I don't know it. No, I'm assuming they won't go back to the original number because it'll be changed with inflation. So no, I think it was around 12,000, 12,500 at that point. But the tough thing right now is when you're retired, most everybody has their mortgage paid off. Kids are out of the house, hopefully. You don't have the deductions. So if you don't have anything to write off, even at $12,000 or $13,000 above that, that could hurt you because you're losing almost half of your standard deduction. So with the standard deduction, now I didn't see any change on, let me look at my cheat sheet real quick. So if you're over 65, there's actually an additional deduction that you get for each spouse.
So if you're polygamous, you get 3 or 4 spouses.
Oh, no, because that's not here. You can ask CPA that. That's a very good question, but. Okay, so it's $1,500 per spouse? So it's an extra $3,000 that you get to write off, so confirm that? Okay, so if you're over that 65 age, then your standard deduction is a little bit over $30,000. That's a pretty good standard deduction there. Means if your retirement income's $100,000, you actually only pay taxes on $70,000 of that. So it kind of goes back to us looking at the different buckets of money. Now, if you all been to one of our presentations at Ruth Chris or educational class over at U of L, we talk about this, different types of money. We have your deferred money, which is going to be your 401ks, your IRAs, any annuities that you have, something that's kicking the can down the road and paying taxes later on when you take money out. Tax now money, it's going to be all your wages, checking accounts, CDs. If you are getting some, CDs are starting to get some decent rates out there. Think about CD, every year you're paying taxes on that interest. So it differs from an annuity, like even a guaranteed annuity. So you get a 4% guaranteed annuity. Every year that interest builds up, compounds, and you don't pay taxes until you take that money out of the annuity. With a CD, every year you get that 4% interest, creates a 1099, you pay taxes on it. So that is something to look at if you're trying to limit income as much as possible. And then your Roth accounts, you're tax-free. Those are the buckets that we love most because you can take income out. When you ask how much we need to withhold for taxes, you say, surprise, nothing. So it's great you don't have to pay the government anything because you already paid the government on that. This is becoming a bigger thing now within the past, say, 5 to 10 years because a lot of companies are starting to use it. And I did see something with the new Secure Act. If you historically had a Roth 401k, did anybody in here have a Roth 401k when they were working? So when you contribute to that Roth, if you contribute to a Roth 401k, your employer always put it in the pre-tax bucket. Now with this change, I can't remember the year that it's changing, the company can choose to put it in the Roth bucket instead of that pre-tax bucket. So that helps you. Now you have to pay income taxes on it at that time they put it in there, but it will help you build that up quicker and quicker. This is the fun part. RMD is changing. So a couple years ago, they moved from 70.5 to 72. Right before Christmas, when they met and passed this, they're increasing to 73 for this year. So if you turn 72 this year, and we're planning on taking a required minimum distribution, you don't have to until next year. So you're good to go. If you don't need the money, don't take it. This gives us more time to do conversions, more time to save on taxes, maybe. But even when reading this law through the way the government wrote it, the IRS wrote it, IRAs were never built, retirement accounts were never built to create an inheritance. They're actually the worst accounts to leave to somebody. Because if you remember the first Secure Act, they changed the stretch IRA, which allowed us to say, my mom passes away, she leaves me her $1 million 401k. I don't know how much it is right now, but let's say it's $1 million. So let's say she does that. I used to be able to stretch that over my lifetime. So I could take an income every year and stretch that over my lifetime. So if I have another 40 years to live, it's a smaller amount of money that I have to take out. Now what they changed is I have 10 years to take that money out. I don't have to take a distribution every year, but by the end of that 10th year, all that money has to be out of that account. Government wants you to pay taxes on it before you die. So if that's your goal is to leave a good amount to your kids, the IRA is really not a good thing to do, to leave them. Yeah, they'll be happy with whatever, even if they have to pay taxes on it. But if say you pass away at 80, they're in their 50s, probably in their prime earning years, they have to distribute this money over the next 10 years, they're going to pay maximum taxes on that money. So Uncle Sam's going to get a bigger piece of that pie than you want him to. So. Oh, another big part it's changing to, where is it? 2033 is changing to 75. This was a pretty big thing. A lot of our clients actually create 529 plans for grandkids, some clients for great-grandkids. But with this change, used to be when you had, let's say, my son gets through college, still has about 10 grand in his 529 plan. So they could take that money out. You'd have to pay a penalty or pay taxes on it. Or I could transfer it to my other son, and he could use it in school. Now, if there's excess funds in the 529 plan, the beneficiary, which would be my son, can actually use that as a contribution into Roth. So if there's 10 grand in there, he can take 6,500 of that the first year, put it into a Roth account. The next year, he can do the same thing. So he can actually benefit from that money and not get a tax hit. Well, ideally, I would have accounts set up for all of them.
Well, I don't have any for my grandchildren, but I still have so much for my children.
And if you can pass them down, or if that's needed, then yes, you pass it down. But then you get to that last kid, if there's still excess money in there, then this is a great option. Minimum for the 529? There's not a minimum on that. I think there is a maximum. I don't know it off the top of my head. Yeah. I think it's on that cheat sheet. But yeah, I think that's a huge thing that happened over the last 3 or 4 weeks. You didn't know that one, did you?
No, I read it before I came here, and I thought that one was great, to be honest.
It's another one that hopefully you don't have to deal with. RMDs. If you forgot to take it or your advisor didn't tell you, shame on Alan for one. But it used to be a 50% penalty if you didn't take it. So if your RMD was $10,000, actually got penalized $5,000 if you didn't take it on time. Now they're changing that to 25%, so it's a lot less. But it's also, at the bottom it says, if there's certain situations and you can explain why, and you have a good reason, it can be even lower. This shouldn't be an issue, but when I do see it's an issue, is a lot of do-it-yourselfers that, yes, the company just sends you out a statement, says what your RMD is. Unless you're paying attention to that, then you can miss it. It's very easy to miss that number. So it's something you just got to pay attention to and make sure, because it's your responsibility to do it. The IRS isn't going to call you and say, hey, you take your RMD. So they did change this too, or added this into there. If you are 59 and a half or under 59 and a half, there's an early distribution penalty of 10% if you took money out of a retirement account. They changed it and added this in there. If you are deemed terminally ill, you can actually take that money out without any penalty. So it's a huge benefit if somebody's younger, has 401k, that, they get cancer. One of my good friends at 32, she got cancer, and this would have been huge for her, where she could have taken money out of her 401k to help pay some of the stuff that was going on. So this can be a huge benefit in certain situations. So this is one of the tax strategies that you brought up. This QCD, Qualified Charitable Distribution. This allows you to take money, historically the way we would do it, when we itemize taxes, we would take money from our investment accounts, we would pay it to the charity, and then we would write it off on our taxes because we itemized. Now, you like my animation, don't you? Now it goes straight from the custodian over to the charity. Now, this used to be linked to RMDs, but they left it at age 70 and a half. So you're allowed to start doing this at age 70 and a half. You don't have to wait until required minimum distributions. But it is a very good benefit because it allows you to send money directly to the charity. You don't pay taxes on that money, but it also counts as a required minimum distribution if you have to take one. So it allows you to bypass that tax. Because if you just did it out of your pocket, the likelihood that you're over that standard deduction limit is very low, so you're not able to write it off. Is that what you were referring to? Perfect. If you're under 70 and a half and you still want to maximize the benefit of your charitable contributions, donor advised fund can be very, very beneficial. So what this is an account. Let's say you typically donate about $10,000 to your local church. Let's say we set it up for a 3-year plan. You have 30 grand set in an account that you don't need. We take that 30 grand, put it into a donor advised fund. You tell that fund exactly how to distribute that money, when to send it to the church. They get their money every year. You get your $10,000 contribution. The big thing is that first year you get to write off that full amount that you put in there off your taxes. So it's a pretty big benefit right there. Now 30 grand, I should have said a higher number because now standard deduction's up to 30 grand for the next couple of years. So let's say it's 40 grand. You get that higher amount. Then at that point, you're itemizing your taxes. Let's say you're at $40,000. Now you get to write off your property tax. We all know those aren't getting cheaper here in Kentucky. And you get to write off anything else that you can. Like I say, you probably don't have mortgage interest or anything like that, but it just compounds that first year. Then second year, you're going to do standard deduction again. Third year, you're going to do standard deduction. And then if we run out of that money because you donated it all, third year you do another donor advised fund. So it's a plan that's going to be like every 3 or 4 years, you're going to re-up it. But it allows you to contribute, allows you to maximize your contributions and deductions. I do have some information back there on the donor advised fund. We use a company called Greater Horizon. So they're very strict on how that fund can be managed. But what they're not strict on is you being able to send the money to the charity. Now, it does have to be a charity. It can't be your son, your daughter. It can't be somebody that you're supporting. It has to be a charity. Yeah. And when Grant will send the video out to you all, it'll have a link. So once you get to that link, if you just hit, I think it's subscribe button, and then there's a bell. That bell will notify you every time we put something new out. So technology, it's fun. But it allows you to get a lot of access to the information we put out there. Well, good deal. We appreciate y'all coming. Hopefully you enjoyed all the pastries and stuff. I cooked those myself. Don't mind the Panera box. It's not real. Well, thank you all.